So today we're going to focus on putting together a common size common size income statement and balance sheet for Walmart, and then also looking at a trend statement for Walmart. Maybe we'll introduce a little bit more about the balance sheet, but this is going to be our focus today. All right, so I updated the Walmart spreadsheet that was saved to the D2L shell. I added the income statement, balance sheet, and cash flow statement. So again, what we're going to be working on is putting together these common size statements. All right, can anyone remind me what is the benefit of looking at a financial statement in common size format? Yeah, exactly, comparative purposes, right? And that's basically one of the main goals that we're trying to get when we're analyzing companies' financial statements. We want to be able to compare them, right? And especially when you're comparing companies across time and between one another, you need a relative basis to be able to compare them, right? So what common size financial statements allow us to do is gauge the performance across companies and across time, right? So using Walmart as the example, is the Walmart today the same size company from 30, 40 years ago? No, right? Generally over time, companies are going to change and evolve. If they're successful, they're going to grow much larger, right? Same thing with any other operating company that's in business today. If you look at it now to any time in its previous history, it's likely going to be larger. So putting their financial statements in common size format gives us a much better basis to compare them. Right? It's very similar to analyzing asset performance when we're looking at returns. Same idea, but we're using financial statements instead of asset prices. All right, so what we're going to be doing with this common size financial statement is we're going to be basically dividing everything by a scalar. Right? And what that scalar is going to be depends on which financial statement we're looking at. So for the income statement, we're going to be scaling by revenues, total revenue. And the balance sheet, we're going to be scaling by, where are my assets? By total assets. All right, so top end of the income statement, bottom end for the balance sheet. All right, so we're going to start with our common size income statement. So we'll just copy over all of our information, get this reformatted to look nice. Going to insert one additional line just so we can get the header. All right, and now we can get started. So we can just go straight down the line here now and start calculating our common size format. All right, we're going to be focusing on our total revenues. Total revenues. All right, so why are we going to focus on total revenues rather than expanding net sales and membership? Why are we scaling by total revenues rather than net sales or membership income? Yep, that is true, but more particularly, some line items might not exist for other companies, so they might not exist for that comparison purpose. So we're focusing on total revenue because that's going to basically be the top line item that's going to be comparable across companies. All right, so we're going to add together net sales and membership income. We're going to add together net sales and membership income because that brings us to total revenues, and that's going to be a comparable item. Right? If we were to use net sales and ignore membership income, right? Membership, it's a small fraction of the total revenue, but it's still a component of that. But that's not a line item that Walmart competitors might have. All right, so we're going to be scaling things by total revenue in each year. All right, so when we're calculating this, relatively straightforward. We just divide everything by the revenue of that year. So I'm going to copy and paste. I'm going to copy and paste this over. And it should be 1. Okay, we're going to put it in percentage format so it's a little easier to read. Maybe get those decimal places. All right, and we're going to fix the denominator because we're scaling everything by the revenue within this year. All right, so fixing reference to the revenue within each year, because within each year we're going to now compare the line items to that year's revenue. Right, that's going to be the scale that's going to give us the relative basis to judge the rest of the expenses and the bottom line of this company. All right, so once we have this top line set up, it's going to be a really simple matter of just copy and pasting this down. So highlight all the cells beneath it. That's okay. And we're not going to be dealing with these diluted values here. All right. And now we have our common size financials, or our common size income statement. Very simple to put together. Right? The important thing here now is to look at any potential significant trends going on within this company. All right, so let's take a second here and look at what's going on. Cost of sales, right? In other words, cost of goods sold. This is the money that's being used to generate the revenue. Right. So as cost of sales increase, basically that's just an additional expense that for every dollar of revenue that the company generates, it incurs that much more in expense to produce that revenue. All right, so this is one of the top line expenses, or this is the top line expense that you're going to see on a company's income statement. Costs that are directly attributable to producing the company's revenue. And as we see, there's not much of a change over this time period. Right? It's remained relatively stable. And this is a trend that we tend to see with larger, more established companies. Right? There's not too much variation in the percent of sales changes year to year. But right, that doesn't mean that this isn't having a significant effect. Right? If we go back to our cause of change analysis, right, changing cost of goods sold, what was a small fraction of a change, right? We had less than a percentage point change can result in drastic differences in the bottom line. Always keep that in mind. Small changes, big outcomes, but nominally, we're not seeing much of a significant change in the company's cost of goods sold. Selling, general, and administrative. Right? These are costs that are just generally incurred by the company that aren't directly tied to each dollar of revenue that the company generates. Right? Also, one thing I want to point in mind, where this company explicitly shows sales and membership income, other companies will break up selling, general, and administrative expenses. Right? This is something that a lot of you all faced with the companies that you're looking at for your project. Right? So you might see marketing and selling expenses, research and development expenses, general and administrative expenses, all broken down into single line items. But the general way to view all those is the lump total cost of selling, general, and administrative. Right? So if your company breaks down these line items, that's fine, that's great, that's just more information for you. But in order to get it on a comparative basis, you're still going to have to add up for this overall expense that the company is incurring with selling, general, and administrative. So keep that in mind, right? Especially when you get to phase 2 of your project where you're going to be bringing in other companies. Even within your industry, some companies might not break down expenses to that level. Some might just have selling, general, administrative, like we see with Walmart here. And again, some might have general administrative and marketing expenses, general administrative R&D expenses, or all three. All right, so keep that in mind and make sure that you're still calculating the selling, general, and administrative cost, because this is going to be the level that you can then compare across all companies. Again, not much of a change here, right? 2023 ended up being the same exact percentage of revenue as 2021. But if we look at the cause of change, right, an almost 10% reduction in the net income from this 1/3 of a percentage point increase in selling general administrative. All right, and this brings us to operating income. Now here we start to see a little bit more noticeable of a trend. So what's going on with operating income over this time period? Yeah, operating income has decreased over this time period. Increased briefly 2022, but then dropped further in 2023. All right, so this might express that the company's operating activities are being less efficiently generated, and this is something that you can look into a little bit more when you turn to the management discussion and analysis. Right, that's going to be the next stage for your project next week, digging into that. All right, so pay attention to trends going on. We've seen a slight increase in cost of sales. We've seen over this full time period, no change in selling general administrative, but this increase in cost of goods sold has reduced our operating income. So cost of sales is generally the largest expense, followed by selling general administrative. So overall, those are typically going to make up the vast majority of companies' expenses, but there are still expenses that are relevant to the company, even though they make up a smaller fraction. All right, so let's turn now and start looking at some of those. Right, so an example, right, almost 97% of Walmart's expenses or revenues are being paid out through these first two line item expenses. So we're only looking at a small fraction of the company's remaining income available. All right, but it's still relevant. All right, debt. What do we see going on with debt over this time period? The company's cost of debt. Keep in mind the financial timeline. So we have the earliest period nearby. Yeah. Earliest period nearby. All right. So debt decreases from just over 1/3% to just under 1/3%. Right. So that suggests that Walmart's paying off its debt a little bit better. Do we see a significant change in leasing costs? No, it seems completely flat, right? Maybe if we expand the decimal place a little bit more, decreased a very slight amount. And sometimes you'll have to do this to see any actual change going on. Interest income. Right? Again, expand that out a little bit more so we can be sure. Looks like it's decreased over this time, or reduced profits even further. All right, so our overall interest expense over this time has decreased, which is good, right? We don't want an onerous cost of debt that can cause significant financing constraints. All right, loss on extinguishment of debt. So this is a somewhat atypical expense, right? We see 2 out of 3 years we don't see any extinguishment of debt, paying off the company's debt outstanding. But in 2022, we saw that did come up. All right, we have our miscellaneous income, right? So might not necessarily see any sort of significant trend here. It tends to be an even smaller fraction of a company's overall income, which brings us to our taxable income. All right, keep in mind this is a step in getting to the company's bottom line. It is not yet the bottom line. That brings us to how much taxes the company is paying. Do we see any trend going on with taxes? It's decreasing a little bit, right? But always keep in mind, taxable taxes being paid out from companies can be a significant expense to the company, but they don't have as much control over it as pretty much every other line item in the company's income statement. All right? Of a company's expenses, taxes are the one they have least control over. Right? Every other expense, there's a lot more companies can do to manage it. And there are things companies can do to manage their income taxes, right? They can change when they're expensing, change when they're recognizing revenue by a little bit to try to modify that income tax. But still, right, companies have taxes that are going to be payable. So at the end of the day, they're going to be paying their taxes, hopefully. All right. And this brings us to our almost the bottom line. right? We're at our net income. Any other additional miscellaneous income being attributable to the company, in this case, particularly non-controlling interest. So companies that Walmart has invested in, but it doesn't have greater than 50% of the company's ownership. And that brings us to the bottom line. And this is usually where a lot of focus is being paid. What is the company's bottom line relative to their revenue? And down here, now we see a much clearer trend, right? Whereas with other line items, we saw some increases and decreases over time, maybe not a consistent path. When we look at net income relative to sales, we see a little bit more of a clear trend going on. What is that trend? All right, so the company's net income relative to revenues started off at 2.42%, then went down to 2.39%, then went down to 1.91%. Is that a positive income trend or a negative income trend? Negative, yeah. Over this time period, Walmart's net profits relative to revenues have declined. Right? We see that nominally as well, right? Net income has declined over this time period. But the important thing to keep in mind is it's possible that net income had increased. It's possible that net income had increased, but still decreased relative to the sales that the company is generating. All right, there's top and bottom line performance, and then everything in between. And it's the combination of top and in between that brings us to our bottom line. Right? Companies need increasing sales over time, or I shouldn't say need. Typically, companies have increasing sales over time to increase their bottom line. Right? Companies try to manage their expenses over time, and as we'll see probably next week when we start looking at MD&A, that is one of the significant costs that Walmart incurs, and one of the significant concerns that they have about their operating performance. Right? Managing expenses efficiently can be incredibly difficult, especially for a company like a retailer, where that's basically their job, managing expenses. All right, so over this time, we've seen that Walmart's net income has decreased relative to their sales. And that's in spite of the fact that we've seen sales increasing over this time period. Right? There's been just a significant increase in total revenues. So we've seen an increase in revenues, but a decrease in profits. So what does that suggest to us when we're looking at this company's performance? In revenues increase, profits decrease, what's going on? Expenses. Yes, something is going on within the company's expenses that are resulting to the lower profitability over this time period. And the best way to dig that out is to also now go back to the cause of change that we conducted. Right? And when we go back to the cause of change, right, we see a significant effect on the company's bottom line through change in cost of goods sold and selling general administrative. Again, those top line expenses that make up the majority of expenses for all companies, but for Walmart specifically, I shouldn't have highlighted all those. For Walmart specifically, made up 96.66% of the company's revenue. In the year before, 95%. Year before that, 95.97%. Right? So managing a company's expenses are going to be one of the important determinants in ultimately arriving at the bottom line. All right, so this is the point of getting common size financial statements, just help pointing out where problems might be when we're trying to evaluate it. Any questions on putting together a common size income statement? All right. Yes. Mm-hmm. Yeah, that's fine. Yeah. Yeah, you're going to be working on that bottom portion for your next homework, or your current homework that's due Sunday. All right, now we're going to copy over the balance sheet. Make it look a little bit nicer. All right. Now we're going to be calculating the common size balance sheet. Right? So with income, the income statement, we were using revenue as the scalar. Right? The revenue is the top line item. But with the balance sheet, we're going to be using assets as our scalar, because this is basically a reflection of the sum total of what's going on here. So revenue was the top potential for getting to your income. Assets reflect the similar thing in the balance sheet. All right, so we're going to be scaling everything now in the balance sheet by our total assets. All right, so fix our references now to our assets. And we can start copying and pasting this. We're going to have to go back and delete a couple of the errors that we're going to see. We're good. All right. So similar to finding revenue as a percent of revenue, it should equal itself, right? So 100% of itself. Same thing when we're looking at the liability side, right? Assets equal total liabilities. It's the balance sheet. It's called that for a reason. All right. Scroll in a little bit so you can see it. Starting with cash and equivalents. All right, this reflects cash, convertible securities that can be converted within the next year, right? Readily liquidable assets. That's how balance sheets are set up. Most liquid at the top, in decreasing liquidity, so least liquid at the bottom. All right, so we're dealing with 2022, column E, 2023, column D. We see that cash decreased from 6 to 3.5%. Do you think that's good or bad for the company? Mm-hmm. Okay. Bad? You're shaking your head now? Okay. Sure. Mm-hmm. Okay. Anything else? Any other opinions, disagreements? So the answer is it depends, right? And that's basically the point. Does the company have investable opportunities that it can be using this cash for, right? Companies do need to hold on to at least a little bit of cash just to have a buffer in case there's some sort of unexpected expense. If there's a shortfall of revenue in a given time period, you need a cash buffer, right? Same thing for your own personal saving goals, right? You should try to have an account that you just have access to in case something goes wrong, right? Having that emergency expense account is very helpful to make sure that you're not taking out lines of credit on really expensive credit cards or something in a time period when you really need it because, right, credit is expensive, especially with interest rates increasing. So cash went down. Is that good or bad? It depends. If the company is using it for productive purposes, great, right? We don't want to see companies holding on to too much cash. Cash in itself is not valuable beyond it just providing some liquidity buffer if there's a shortfall in revenues or an unexpected increase in expenses. Right, so it depends. Receivables, they stayed roughly the same. Right, so not much of a change going on there. And similar with inventories. Right, but inventories is something that you have to keep an eye out on and just understand that there are going to be cross-industry differences. Right, so Walmart is a retailer, meaning it puts stuff on shelves and sells it, which translates to we should expect Walmart is going to have a significant amount of inventory. Right? When we look at other companies, we'll see that inventory tends to not make up as much of a percent of the company's balance sheet because they're not expected to hold as much in inventory. Right? And in general, having a leaner production process is going to be beneficial. So there's been a decline in inventories being held for a lot of companies over time. Right, so inventories are going to be needed. How much are going to be needed just depends on the company's industry and what they're operating in. Prepaid expenses, right? This reflects expenses that have already been paid and that they haven't collected the asset for it just yet, right? Or haven't collected the service or product. And it's increased slightly. So now is this going to be something that reflects a positive or negative change. Okay. What's that? Mm-hmm. Mm-hmm. Okay. So you almost got to the point we're trying to get here. Remember time value of money framing, right? The earlier you receive a cash inflow, the better it is, the more valuable it is. The further out you can postpone a payment, the better off you are, right? Because the timing of cash matters. The earlier you receive a cash inflow, the more valuable it is. The later you pay an expense, the less costly it is. So what this reflects here is the company's incurring a little bit more expenses earlier on, right? So on a time value of money basis, this isn't necessarily a great thing to see, right? Prepaid expenses, yes, you're incurring the cost early on. You've taken care of that cost. It's finished. Great. You're going to get whatever you need whenever it's contractually arranged. But from a pure time value of money perspective, this reflects the company's incurring costs earlier on, which is in a way the opposite of what you would want optimally. All right, so total current assets have decreased from 33% to 31%. Right, does anyone remember how current assets are related to calculating free cash flow? All right. All right. So free cash flow is revenue minus cost of goods sold minus selling, general, administrative. So your operating income that the company is generating, plus depreciation and amortization, non-cash expenses that companies incur on their income statement. So offsetting that, minus capital expenditures, investments or actual cash outflows from a company, and minus change in net working capital. So in other words, current asset balances. So change in net working capital my handwriting is the reason I try to use PowerPoints. I'm sorry. Change in net working capital is equal to current assets minus current liabilities today, minus current assets deducted from current liabilities of the previous time period, last year. So if we see a reduction in the current assets, which is being subtracted from free cash flow, right? In other words, net working capital is inversely related to free cash flow. So if we see a reduction in current assets, what's happening to the company's cash flow? Everything else equal. Right? So if everything else is equal, change in net working capital is decreasing. Right? So we have minus a negative value. So what's going to be happening to free cash flow? Exactly. Yeah. Right? As net working capital decreases, free cash flow increases. What assets reflect is cash being tied up in the production process, particularly in the sales and operating process. So if we see current assets decreasing, that means cash is being freed up for other purposes, other typically more productive purposes. So if our change in net working capital is decreasing, that's increasing our free cash flow. right? So when I say everything else equal, this just assumes that everything else going on in free cash flow is staying the same, but a reduction in free cash flow, or I'm sorry, a reduction in change net working capital is going to increase our free cash flow, right? So if everything else stays the same, this reduction in total current assets might be a benefit to the company's free cash flow. Maybe they're using this additional cash for more productive purposes. Right? Any question on current assets? All right. Yes. What do you mean? In and of itself is a benefit. All right, but other things can be going on that interact with it that you still have to look at the company's free cash flow overall. Change in net working capital is just a relatively small subset of the company's overall cash flows, right? So you have to look at the bigger picture to see what their overall cash flow is. But in itself, a reduction in current assets reflects an increase in cash flow. But keep in mind, right? Current assets is only one part of net working capital. What's the offsetting part for net working capital? Exactly. If liabilities decreased by more than current assets decreased, then we're going to see an actual increase in change in net working capital, right? So when I say that current assets decreasing increases the company's cash flow, there's still a lot of other components to that cash flow that you have to evaluate. This is just one small fraction of it, right? But yeah, good question. All right. Moving on to what is typically the largest component of a company's assets, property, plant, and equipment. All right, so typically we do see that this is the largest, and between inventories, property, plant, and equipment, right, we're at about 65% of the company's overall assets. All right, and property, plant, and equipment are typically some of the more productive assets that companies have in place, right? So for Walmart, broadly speaking, these reflect the buildings that they sell their goods and services out of, whether it's in person or online retail, right? So if companies want to be producing revenue, they need this property, plant, and equipment in place producing that revenue. All right, so we've seen an increase in property, plant, and equipment over this time period. Next, we see some leasing assets, right? So leases reflect similar to property, plant, and equipment, but it's something that the company doesn't have explicit ownership of, right? They are leasing that property in order to generate those revenues from. All right, last we have the intangibles, goodwill, other long-term assets. Right, so goodwill usually reflects the premium that companies pay for acquiring subsidiaries. All right, so this is going to be the difference between the payment that Walmart pays for a subsidiary and how much that company would cost if you were to go to market for it. All right, so over time, sometimes we'll see companies' goodwill increasing, decreasing. It's not necessarily as informative of information, but if we see a really high increase in goodwill, that could send a signal that the company might be overpaying for some of its subsidiaries. Right. Other long-term assets, intangibles that get amortized over time, something like IP, not necessarily as important for a company like Walmart, but if you're in the creative business, music, movies, stuff like that, becomes a lot more important, much more productive asset. Bless you. All right, onto the liability side. All right, remember, assets equals liabilities plus shareholder equity, or assets equals total liabilities. The first portion that we're looking at, again, it's decreasing in liquidity. Right? So everything we're looking at in this section now, the liabilities are commitments that Walmart owes to creditors. Whether it's in the short or long run, these reflect financial commitments that the company has. All right, short-term borrowings. These are basically just short-term loans that the company has taken on. Nothing too exciting about that. Accounts payable. So this is going to be one of the significant components for changes in net working capital. Accounts payable reflect costs that the company has incurred but has not yet paid off. Accounts payable makes up a pretty significant portion of the company's liabilities, right? Reflecting the company having a large inventory in stock, right? So the company stocks inventories, not necessarily paying for them in full at receipt, and paying down those payables some point in the future, right? When I don't remember if I mentioned it on the asset portion, but when an asset or liability is reflected in the current portion, that means typically within 1 year. Right? If you're operating and using this within 1 year, it's going to be reflected under the current portion. Right, so accounts payable is usually some of the largest proportion of a company's current liabilities. We have accrued liabilities and income taxes. So these are payments that the company is going to have to make in the near future. Right? But again, increasing our expenses being paid in the future on a cash flow perspective, everything else equal on a time value perspective, that's beneficial. Right? Cash inflow early on, great. Cash outflow later on, great. Right? The opposite condition of that is when financial difficulties set in. Then we have the current portions of long-term debt, right? Long-term debt due within 1 year. So as companies issue bonds, this is going to be reflective of the costs that are going to be incurred early on. And now we operating lease obligations. So again, paying off leases. That brings us to our total current liabilities. So total current liabilities increased from 35 to 37%. All right, so remember, total current assets decreased from 33 to 31. Total current liabilities increased from 35 to 37. All right? So what this suggests to us is that total change in net working capital decreased. Right? Our current liabilities increased, our current assets decreased. So we've had a reduction in change in net working capital. Right? So now we're getting closer to the bigger picture of generating a company's free cash flow. Change in net working capital decreased, free cash flow increased. These two are inversely related, but changes in net working capital are usually one of the smallest portions of free cash flow. Oh, actually, I forgot a very important cost for the company. Paying taxes. Okay. But change in net working capital is usually a small portion of a company's free cash flow. All right, so this brings us to the longer term costs of the company, long-term debt, so bonds that are expiring later than a year that the company is going to have to be paying down, operating lease obligations, so the counterbalance to the lease that the company has on the asset side. That brings us, oh, it doesn't have the intermediary total liability. All right, so if we added up all these liabilities, which, yeah, they didn't explicitly do, we'll just put off to the side here. Total liabilities increased from 240 to 251. All right. So, would you say this is a good or a bad trend? Bad. Okay. Right. The company has engaged more obligations. In itself, yeah, I think you could see the argument that increasing your financial obligations is not necessarily the best thing. But it also kind of depends on what those liabilities are tied to. Yes? Yeah, that's the other component to it, right? Companies need capital in order to make investments. So when a company's liabilities increase, that might not look like a good thing, but it depends what assets and how productive those assets it's tied to. So if companies are raising capital and that capital is being used for investing in some assets that generate a return on investment greater than your cost of this increased liability, then overall that would be a good situation, right? We want to be pursuing value-adding opportunities. So if we pursue assets that are generating a return on investment that's greater than the cost of additional liabilities, we see a net benefit overall. All right, this brings us to our last portion, looking at the equity. Keep in mind, when we're looking at equity, this is book value equity, not market value, right? So generally speaking, we see that the market value of company shares is much greater than what is reported in the financial statements because these are historical book valued amounts, right? So common stock, relatively small, right? These are in millions. So is Walmart worth more than 270 million right now? Right, let's look at the total market cap. Market cap, 440 billion, right? So obviously, Walmart's market value is greater than its book value being reported on its balance sheet. That's going to be the case when you're looking at publicly traded companies, which you all are right now. All right, so we have our common stock. Again, this is just the book value amount, not necessarily as informative as the market value. Capital in excess of par value, so seasoned equity being offered, that company is issuing. And one of the most important parts of the equity portion, retained earnings. All right, what do retained earnings reflect? The accumulation of previous profitable years. Right? When companies generate their net income, their bottom line, right, this bottom line is split into dividends being paid out to shareholders or retained earnings being held within the firm. That's all that is done with net income. It's either retained within the firm or paid out to shareholders in the form of dividends. So what we're looking at here with retained earnings is the accumulation of all previous year's earnings. And hopefully those earnings are being used for valuable investments, right? Same idea with liabilities increasing. As we see our equity portion increasing, we want to see those being used for productive purposes. Right. So we see a slight decrease in retained earnings, right? In part because we see a decrease in retaining earnings over that year, right? Not because we've had a significant increase in total assets, right? Actually, total assets declined just a little bit. So we see that retained earnings have decreased as well. Not necessarily the best sign, right? Over time, we want to see value-adding companies, and so we should see a growing retained earnings and growing in proportion to the total balance sheet. But we've seen that the company hasn't been performing as well over this time period. All right. Lastly, equity in non-controlling interest. So that's going to be reflective of the income that the company received right above the very bottom line, right? So this is equity that the company has, but a non-controlling stake, right? So less than 50%. That brings us to the total equity for the firm, and we should see that when we add that up, it equals oh, did I misadd something? Find out real quick. 24. Looks like too high of an expense to be deducted out. Right, and it also depends on whether they're the owner of that subsidiary or whether it's other companies that have that subsidiary ownership of this company's subsidiaries. So it depends on the company itself. I'll have to play around with this, dig into it to figure out what is not what I'm missing. It's a small value. Yeah, I can figure that out outside of class and email you an update. All right, so general trends that we want to look at when we're looking at the company's financial statements: changes in net working capital. How is their capital balance being used? If the company's liabilities are increasing, are we seeing that being offset in productive assets like property, plant, and equipment? And are we seeing growing retained earnings over time? And there's other information contained in the balance sheet. I guess we can start talking about that now. We have a little bit more time. Any questions on putting together a common size balance sheet? All right. I forgot, there's one last thing I wanted to look at as well, and that's putting together the trend statement. right, which is something that we mentioned early on in class. Oh, all right, so we're going to be doing a trend analysis, looking at the company's line items from the starting year through the ending time period. All right. So a common size financial statement is looking within each year relative to itself. So you're standardizing, right, the year's net income relative to its revenue. With the trends analysis, what we're going to be doing is we're going to be looking at each line item to the history of itself. All right, so our baseline for each year is going to be equal to the item in the base year, right? So rather than scaling to the line item per year, we're scaling by years. So dividing each item by itself. We're going to fix reference to the denominator because we want everything else to, we want the numerator to vary. That's the information that's going to be changing. All right. And once we fix our references, we can copy and paste this over. Now we can start seeing any potential aberrations over time. All right, so starting with revenue, right, we see that revenue has been increasing, but from the baseline of 2021, it's increased about 2.25% 2022, and in the next year, it's increased another roughly 6 percentage points to a total gain of 9.12%. In general, that's a trend that we want to observe, right? If companies are operating and investing their assets well, we should see growing revenues over these time periods. All right, so that's exactly what we see going on with the revenue. As we saw already, though, right, bottom line performance was not as good. So we're going to see some costs likely increasing over this time. Right, so cost of sales increased by 10 percentage points. Right? This is a sort of trend that might be concerning. I forgot to zoom in for you all in the back. This is a trend that might be a little concerning to see, right? When we see costs increasing at a greater rate than we see our revenue increasing, that suggests that the company's bottom line is going to be narrowing, right? Shrinking, potentially unprofitable. If this trend were to continue, it would suggest that eventually the company is going to become unprofitable, right? The trend that we want to see is the interaction between increasing revenue, decreasing expenses, proportionally speaking. Right, so we see cost of sales increasing. Right, cost of sales. When we go back to our cost of good, our cost of change analysis, this was the largest factor affecting our income. Right, so it's not surprising to see that our trend of cost of sales is increasing over this time period. Selling, general, administrative increasing as well. Relative to the net sales increase, it's a much smaller increase relative to cost of sales, but it's still increasing. And another slightly concerning trend that we start seeing is operating income decreasing. Now, as we go down, we see some significant changes going on. Right? So these are the smallest line items. Remember, the expenses for cost of goods sold, selling, general, administrative were making up about 97% of Walmart's revenue. Right? So all of these are small fractions, but we're still seeing some significant changes going on. Right, so change in debt, not much going on. Looking at net interest overall, we see the cost of that's going down. So that's a good sign, but small cost for the company overall. Other gains and losses has changed significantly over this time period. All right, we go from negative 200 to positive 3,000 costs that the company is incurring. And this brings us down to our income before taxes, and then our the amount of taxes that we're receiving. All right, so as we are reducing our operating income, we should see our operating tax falling, but this third year seems to combine a higher tax expense than the year before, despite having a lower amount of taxable income. Right. Bring us to our smaller line item for income or loss from non-controlling interests, and down to our bottom line. Right. Again, similar to the trend that we saw in the common size income statement, looking at the trend from the baseline net income in 2021, we see a slight increase and then a drop down. All right. Again, as we've already observed from our cause of change and our common size, this is almost entirely being driven by our changes in cost of sales and selling general and administrative. Any questions on putting together a trend analysis? All right. All right, so we'll spend just a couple minutes here and then end class. And if you have any questions about your homework or project, we can talk about that. All right, so when we're looking at a balance sheet, from a finance perspective, we're looking at sources and uses of cash. Liabilities reflect sources of cash, money that the company can use. The liability section tied to explicit obligations that the company owes. The equity portion generally reflecting either equity ownership or increases in retained earnings, right? Previously profitable years accumulated. Right, so assets, these are just resources that companies control that are expected to provide future benefits. Right? When we're looking at a company's property, plant, and equipment, those are what are going to be some of the largest drivers of generating companies' revenues over time. Okay? You need manufacturing warehouses to produce computers. You need coffee shops to sell coffee. If you're Walmart, you need shelf space in order to sell the goods that you're selling to consumers. Right? So assets reflect these resources that companies are going to use to provide future benefit. Liabilities that we're looking at are direct obligations that the company owes, right? So an outflow of resources. And equity is a reflection of owners' interest on the company overall. Usually, if the company's assets are generating revenues efficiently, if we're generating those cash flows, if we're generating that income, we should expect equity to naturally grow over time. Always keep in mind the balance sheet identity. By construction, assets are going to equal liabilities plus shareholder equity. Right? By construction, that is the case. That's how the accounts are set up, and it should always be balancing. All right, so what are we using this information for? Right? And there's a lot of great information. People will often talk about the bottom line on an income statement, but that's just a snapshot of a company's performance. In many ways, the balance sheet reflects the accumulated performance of a company over time. Right? So when we're looking at the company's balance sheet, we can assess that the company's liquidity, its ability to pay the short-term obligations, right? Generally reflected in net working capital. We can also look at the company's long-term obligations that it has. Has the company overextended itself on the debt that it's going to be issuing? And what's the company's ability to make payments to shareholders? Right? We should see that growing retained earnings if they're increasing their ability to pay. Like I already mentioned, keep in mind the balance sheet does not necessarily reflect market value, and very often it doesn't, right? Especially when we're looking at the equity portion of a company's balance sheet. Many of the items in the balance sheet are listed at historical cost. Right, like we saw that difference in Walmart's market value versus its book value on its balance sheet. There's a drastic difference. Right? Literally orders of magnitude difference in the common stock value on its books relative to the market value. Right, so always keep that in mind when you're looking at the balance sheet. There is a difference between book value and market value, and it can be significant, especially with older companies. All right, so the operating cycle, this is the time that it takes to get the raw goods and services you need to produce whatever you are making. You sell whatever you're going to be producing and then collect cash. That's the total operating cycle. And this is important because it's going to reflect on what is a current asset, what is a current liability. All right, so by definition, current assets, the cash that's tied up in the production process, are assets that are likely to be converted to cash within 1 year or one operating cycle, whichever is greater. So typically, it's within a year time period that we refer to current assets and current liabilities. Similar current liabilities, these are obligations likely that are going to be settled over the next year. And then working capital is our mix of current assets and current liabilities used in the production process. Current assets minus current liabilities. From a free cash flow perspective, reducing our net working capital, our change in net working capital, is going to be increasing our free cash flow. But companies are going to need to have some amount of cash on hand in order to handle issues. Right? Companies are going to need some amount of inventory on hand in order to sell their product that they're producing. They're going to need receivables in order to make some sales. Right? So it's the sort of situation where it's not going to be zeroed out typically because you need these in the production process. But it's one of those, too much is not going to be a good thing.